Hey there, everyone. Welcome to this continued special series here at year-end 2023 called the Top 5 Charts of 2023. We've covered a lot of ground so far in our first three charts. We talked about the S&P 500, the top-level analysis of the S&P quarter by quarter. We talked about interest rates. We dug into the 10-year, talked about the shape of the yield curve. In our third video, the most recent one, we talked about breadth conditions and looking at market breadth, talking about narrow versus broader advances and this setup we have currently at the end of December. That brings us to chart number 4, which is where we're going to deal with leadership. We're going to talk about some of the leadership trends. Arguably one of the more important themes that we experienced in 2023 was this concept of narrow leadership, right? The Magnificent Seven was not something I remember hearing a couple years ago, and all of a sudden that has become a term that I've used multiple times a week, if not multiple times an episode of our daily show, The Final Bar. But as we continue on here, we're going to dig into some of the nuances of leadership, what has happened through the course of 2023, and really thinking about where we're at here at the end of the year as we set up for the beginning of 2024. Before we get to a couple charts talking about leadership trends, I do want to let you know about a special we have going on at Stock Charts. Our holiday special is the perfect time to become a premium Stock Charts member when you get to our paid tiers membership, and it is one of the most underpriced and undervalued tools, I think, in the financial industry. You have so many great capabilities for a small monthly or annual charge. Basically, give you the ability to have chart lists, much larger chart lists, scanned for all sorts of details in the equity space, looking at real-time alerts, and using the ACP platform, accessing a bunch of premium tools that are only available to our paid members, and also premium commentary from people like John Murphy and Martin Pring, some of the most noted technical analysts in the financial market history. If you go to stockcharts.com/special or get your phone out, there's a QR code we'll be showing here that you can access our special deal here at the end of the year. And if you've never been a member, now is a perfect time to do it. Gift yourself, treat yourself well here at year end, and set yourself up for success in 2024. With that in mind, let's get to our chart here. And what we're going to do is talk about leadership. And what I'm doing is actually looking at cap tiers in 2023. And this is the fourth of the top 5 charts of 2023. We're going to start with this one. I'll show you a couple other charts that I think tell this story very, very well. But just so you know what's happening, it's kind of a spaghetti chart, so forgive the busyness of this chart, but I'll show you what we're doing. We're starting the clock at the end of December 2022. So we're looking at the 12 months or 11 and a half months that have played out here in December. And I have lines basically illustrating the 9 Morningstar style boxes, right? So you have core, growth, and value, right? So you have growth on one side, value on one side, then core kind of in the middle, combining those two. And then you have large, mid, and small, looking at market cap ranges. And then I have a 10th one, micro cap, which is looking at those, again, very small companies here at the bottom. You can see the indexes are all listed off here, but I have the labels just to make it a little easier to show visually how these things have performed. And if you're really looking to recreate this kind of chart, at the bottom, if you hit pause, if you come back and review this later, I have the tickers of these 10 different ETFs listed out. And what's great about ETFs in 2023 is you basically have a slice of the market for any area that you're looking at. I mean, if you're looking at a very narrow theme or a broader look at different markets, ETFs provide you pretty liquid data or a data series based on a pretty liquid instrument, so you can really understand these markets and how they're related better than I think you ever have if you're an individual investor. The capabilities are pretty awesome. So let's look at what the performance has been like in 2023. You can see, of course, all of these cap tiers following this general progression of strength in January, sort of a pullback in March, a nice rally going into the summer. Most of them, if not all of them, peaked out in July, August. Then we had this retracement lower where a lot of these made a new swing low, and in the case of microcaps, a new low for the cycle here in late October. And then all of these have been rallying off of the low in October. But by mid-December, you can see there's quite a bit of differentiation. You'll notice this blue and the black lines are pretty obvious at the top. Pretty much since mid-March on, it's been clear that these have been the top performers. And those are the large cap growth ETF and then large cap core, which is basically the S&P 500. So here in mid-December, the S&P year to date is up about 26%. Pretty nice up year, to be honest with you, given all the choppiness and uncertainty at times, and given the complexities or the concern, I guess the really unique experience we've had with inflation that has been high and has been coming down, with the Fed an aggressive rate hike cycle, and an unclear finish line as to what they're going to be doing. Even with all that in mind, the S&P's had a pretty solid year, up 26%. But large cap growth has outperformed that by about 400 basis points, meaning about 4%. The large cap growth ETF is up almost 30% year to date. Now, this is where things get interesting. Large cap value is the third best one, up 21.5% year to date, if we'll call it. Then there's a big gap down to mid cap growth, all the way down to small cap value, and kind of everything in between, all clustered here in sort of the 14 to 17% range. And then micro caps, a clear underperformer, up only about 7% year to date. So think about what that means. This year, I was sort of thinking going into 2023, it was going to be a lot about growth versus value, right? And it was all about understanding, are you in the growth side of the equation, technology, communication services, consumer discretionary, sort of those FANG sectors or those Magnificent Seven sectors? Or is it more value, things that had not been performing particularly well, certainly in previous bull cycles like 2021, but given the fact that rates were going up, certainly seemed like value stocks would be in a much better position. Those would be sectors like financials, industrials, materials, defensive sectors like utilities and real estate, certainly in that value bucket as well. But thinking more about value leadership, energy, obviously one of the big value sectors to think about. It wasn't to be, and I think when I reflect back on 2023, one of the most important trends that I think we focused on was large over small. This was not a growth over value story. Although being in large cap growth over large cap value, you still outperformed by about 8%. So that's not bad, right? Recognizing that differentiation. But anything large over anything not large was really the trade, right? It was all about the biggest names, the mega cap names doing the lion's share of the returns. And if you look at a heat map of year-to-date returns, the biggest, brightest greens are in the mega cap names, those Magnificent Seven names. We're going to look at a chart of some of those Magnificent Seven stocks, if not all of them, here through the course of this particular video. But I just want to highlight how mid caps and small caps, even if you made the right call on growth over value, it really didn't get you much, right? And that's something that I think is important. My recent interview with Julius DeKempener, he was on the show just last week. We talked about that idea that it was not about growth over value, it was about large versus small. And I would encourage you to check out that interview from last week's show as well. So another way to think about sort of this performance year to date is by looking at our major benchmarks, right? So we have the NASDAQ 100 up 54% year to date. And that's not a typo. That is up 54% year to date. A lot of that came off of the October low, right? In late October, we're talking about being up 30%, which seemed pretty good. We've almost doubled that here by mid-December here, up 54% year to date. Here's the S&P languishing down at a meager 26%, which I'm saying that with a great deal of sarcasm. Solid year for the S&P, but an even better year for the NASDAQ 100. Then basically tied for third, the bronze medal goes to small caps, the IWM, which is the Russell 2000 ETF, and the Diamonds DIA, which is the Dow Jones Industrial Average ETF. Those were both up about 16% year to date. So look at the gap between the NASDAQ 100 and the S&P. Just owning the NASDAQ instead of the S&P, you would have outperformed so far by a whopping 30% almost year to date. And what that does is basically reflect the strength of the mega cap names, right? Because if you think most of the NASDAQ 100, if not all of them, and I should probably know that, I bet all of them are included in the S&P, and if not, it can't be many that are not. So you basically have the mega cap growth part of the S&P or the everything part of the S&P. And so this shows you how much those mega cap growth names have been fueling the returns in the S&P itself because of this gap in returns from the QQQ to the SPY. Then there's another big gap lower, about 100 basis points or 10% down to small caps, which have been a big laggard in 2023, and the Dow Jones Industrial Average. And the problem there is you have a little bit of growth, but it's a lot more value, right? There are banks and transportation companies and other big sort of blue chip industrial names in the Dow, and those have not been the stronger parts of the market. So being in the Magnificent Seven certainly mattered. Being in the right sectors and being in the largest names has been the number one investment thesis to get right in 2023. And if you think about being a money manager benchmarked versus the S&P 500, this shows you why the Magnificent Seven have thrived so much, I think, over time. Because if you are a fund manager, let's say you run a $10 billion fund and your benchmark's the S&P, you have to own those names, right? If you don't own those big mega cap names, you're getting absolutely crushed on a relative basis. And that's what you're paid to do, is to outperform the benchmark. So the outperformance of these names fuels additional flows to those names because fund managers that don't own them have to own them. And as a result, this just perpetuates that trend of outperformance. So I think we've made the case of that dominance year to date. And again, all of them have moved in similar progressions. You have sort of the strong first half of the year, the weaker third quarter, the very strong fourth quarter, and really that was November and December coming off of the October low. Really, regrouping or I guess retracing back to the summer highs and then eclipsing them for pretty much all of these benchmarks at this point. Now let's finish off by looking at some of those individual stocks that make up the Magnificent Seven. And we're going to go to this chart list that I have called the Magnificent Seven and Friends. What I'm going to do is use this tool. When you have a chart list on stock charts, I use this tool called View All the time. And all this does is basically show you the charts in order. And then you just need to take your mouse and flick to the upside and go through one versus the next. If you have a list of charts like ETFs or stocks, a watch list, a portfolio, even a group of stocks that you think are important to watch like Magnificent Seven, put them in a chart list and then do this View All visual. And that just allows you to just quickly go one chart to the next. I use this every day, multiple times when I'm looking at results of a scan or looking at important charts like this. Now, I've grouped these into three different buckets. The first bucket are the breakout names. These are names that are at the end of 2023 at highs or have already made a new high for the year here in the fourth quarter. So these are the stocks out of that Magnificent Seven, which are really 8 of them that I'm including here. I'm calling it Magnificent Seven and Friends. These are the ones that are already breaking out. Meta, arguably the strongest one of the bunch. Here in November, we made a new high for the year, and then again in December. What's interesting about the chart of Meta is that we hit a significant resistance level in July. We retested that high in October, and then finally broke out in November. I use this rectangle annotation just to show this range because we pulled back on the lower end to around 280, 290, and those ended up being the lows of this basing pattern. So you had a big rally off of November of last year, the first 6 months of the year just ripping to the upside. Then you had August, September, October into mid-November really sideways, more of a consolidation phase, resolving to the upside. And I think that's a key takeaway as we end 2023 is that about half of these charts have already broken out and are finishing the year for now in a position of quite a bit of strength. So here's Meta making a new swing high for the year, not overbought yet, by the way. And another important metric to look at. The second chart is Amazon. Similar idea to what we saw with Meta in terms of a strong first half of the year into a summer peak. Amazon actually peaked out a little bit later here in September. But if you look, the third quarter sort of settled into this range on the lower end around 120, 125, on the upper end around 145. We rallied back up and spent about 4 or 5 weeks up around this resistance level, around 145 to 148. But then finally here in mid-December have resolved to the upside. So I was taught the most bullish thing a chart can do is go up. So the fact that these charts are breaking to new highs, I don't see as anything but bullish, right? As long as we keep making higher highs and higher lows, Charles Dow taught me that that's a pretty meaningful rally. And as you see charts like this breaking out, of course, what you're looking for are any sort of pullbacks and making sure that pullbacks would hold support. So on a chart like Amazon, I think you have very clear levels to look at on the downside. And you've seen that hold in previous parts of the cycle as well, right? Look in July, we made a new high in mid-July, pulled back to a previous support level and an ascending 50-day moving average. We made a new high. We pulled back to the 50-day again and pushed higher. So that ascending 50-day moving average is often a really interesting starting point or a level to look for on a pullback. So I think you have clear levels of support just based on some of those previous swing lows. The third chart, Microsoft, this is kind of an interesting one because you made a new high most of the months, first months of the year, right? February, March, April, May, June, July. Every one of those months you made a new high for the year. Then we sold off here, right? And Microsoft had almost an inverted V kind of top, kind of an unusual top with a spike higher and then a spike lower. But then we came back and settled into this range. Microsoft between 310 and 340 for this 3-month period, 2.5 months. And then we broke out in late October, right around Halloween. We actually pushed to the upside, then made a new high. And what's interesting about this is the high from July has now become support here in the fourth quarter, right? So you can see this level around 365, we'll call it, for now has held. So resistance often becomes support. That is a technical concept called polarity, where you have a resistance level that becomes support or vice versa. So watch that 365 level. Watch the ascending 50-day moving average, currently around 357, 360. You see if we would pull back any further, that's kind of the level you want to hold. But as long as a level like that holds, this is still over the medium-term time frame, I would argue, a pretty constructive chart. Note, by the way, Microsoft not overbought as well. None of these charts at the moment are overbought. This fourth one is very, very close to doing so. This is Netflix, right? You look at Netflix, I thought this is a great illustration of the peak in July, a lower high in September, and just the value of drawing a trend line. This is kind of the, I don't want to say the lazy person's technical analysis, but it is not the most, I think, robust technical approach I've ever used, but it is a handy visual tool, right? A visual representation of the pace of the trend. All this trend line tells me, and this is why I draw trend lines a lot on the charts, just a quick visual tool telling you, okay, we're going down, right? We're making lower highs. Wait for us to stop to break that trend line, which means we're no longer making lower highs. We're all of a sudden starting to break above that trend line, meaning the pace of this downtrend is now changing. Something's different. And sure enough, once that downtrend line was broken, that told you we were now in an uptrend phase in November. What that also means is right about now, here in mid-December, we can use that same sort of mentality and draw a trend line off of the low. So let's take the October low and connect that to the mid-December low. If I correct the drawing of my trend line, there we go. I now have a pretty good trend line representing this new uptrend. I have the low in October, connecting that to the low in December. As long as we remain above that trend line, again, it just tells me things aren't getting that bad. If and when we break below that trend line, it's probably more when than if. That tells me just something might be changing. That might be a great time to revisit that chart. What's interesting about the chart of Netflix, by the way, is we're making potentially a new high for the year here in mid-December. As the RSI is right around that 70 level. What you want to look for is the price to go higher, and what you really want is the momentum to continue higher. What you don't want is higher highs on weaker momentum. That's called a bearish momentum divergence. We observed that here in January, February. Price higher on weaker momentum. We saw that in June and July, which ended up suggesting a major top. That's what you're not seeing yet, but you may, right? And that's what you need to look for is when we finally establish a new high, is the momentum continue to go up or not? And that's why I think Netflix might be an important one to watch here as well. So that first group of stocks are all making new highs. That gets us to the second bucket, which are the ones that are testing resistance, but have arguably not broken out yet. And that's that second bucket of Magnificent Seven stocks. Here's Apple. And again, testing resistance just below $200 a share, big round number. The RSI for now appears to actually be a bearish momentum divergence, which is a cause of concern for me, right? Higher highs November to December, lower momentum, which suggests weakness in this uptrend and questionable whether Apple will be able to make new highs. Here we have NVIDIA, again, a great setup, but it's not quite broken out yet. I think you really want to be patient on charts like this to wait for a breakout. If it does, it's almost a cup and handle like pattern, but NVIDIA would have to get above 500. The RSI for now, not yet overbought. Finally, we have Alphabet. Again, a great setup, a great year, right? Going from 86, 87 at the end of last year to 137 here in December. That's not bad for a 12-month performance on any stock, but we're not quite breaking out yet. You have resistance here in September, October, November, even December, all in this 135 to 140 region. We're once again testing it. So this second group of names, I would argue, still a little bit to prove. We'll see if they're able to push above resistance through the end of this year, beginning of next year, but those would be some of the actionable levels I'd be watching there. That brings us to the third bucket, which only has one stock in it, Tesla. Tesla is sort of the other category, right? It's not a breakout name. It's not a name that's made new highs. It's not a testing resistance kind of name. It's something that's still going, that's still, I would argue, medium at best. It's a neutral. Now, I drew this pattern, which you'd probably call a coil pattern or a symmetrical triangle pattern. That's where you have any sort of trend, and then we settle into this pattern of lower highs and higher lows. You can see we broke down. We actually gapped down below that pattern in October, which in our opinion was a key sell signal. We found support just below $200 a share, and then have recovered quite a bit. We're actually back to that midpoint around 260. I'm now watching this trend line here. I'm just going to update it a little bit. and take it to where we're at now. And you can see why this trend line, I would argue, still kind of important, right? The highs from July, September, October, very close here. We're right there, and arguably are just breaking above there in mid-December. So this is a third bucket, which is sort of still a lot to prove. But the fact that we're breaking above trendline resistance, the fact that we're back above both of the moving averages, the fact that the RSI is above 60 and appears to be pushing higher, all of that is pretty encouraging. But I would like to see some follow through to the upside. And similar to the other charts we looked at, you could draw trend lines off of these lows as just a quick visual cue to make sure we stay above that, that sort of lower end of the uptrend. But overall, really starting to emerge in a position of strength. So when you look at all of these magnificent 7 stocks, right, and you look from the top with Meta making new highs down to Tesla and others sort of languishing, attempting to break out, but not quite able to do it yet. Maybe Alphabet and Tesla, the most questionable out of the 8. But it really shows you, all 8 of these charts, significant strength in 2023. Some of the top performers, certainly. And when your top performers are all mega cap growth names, that is what allows our benchmarks like the S&P and the NASDAQ to have such a significant upswing. So with this video, sharing you the 4th chart, which is really looking at performance of these different cap tiers, some of the leadership themes in 2023, what I wanted to show you on this particular video was the ChartList feature, and particularly viewing all of them together. When you create a list of charts, and as a reminder, if you're new to the Stock Charts platform, welcome, and if you're an established user, make sure you use ChartList. Other platforms are set up in different ways, and I know when I learned the stock charts at the beginning, the concept of chart list is an important one because basically you don't group tickers. It's not a watch list. You group charts, and that's a way you can build watch lists and lists of symbols that you're looking at, but you want to save the charts first, right? So you want to create a chart that you think is really important, and then you want to save the chart to one of your chart lists. That's how I created this list of charts that we're using for this special series. This is how I have all the main chart lists that I follow. And once you have an important list of charts, like my Mindful Investor chart list, what you can do is do what's called a view all. And when you're looking at a chart list in the upper right, this gives you the different things that you can use to analyze a list of stocks or ETFs. You can use a candle glance, which is where you put all of the little thumbnail charts on your screen. I use that all the time to just glance through a bunch of things and visually scan through the charts for outliers that I want to pay attention to. RRG, how cool is it that you can bring up a list of stocks or ETFs and then go to an RRG and immediately look at the relative performance of that group of stocks versus benchmarks versus other things, other reference points that I want to pay attention to. One of the things that I use all the time is what's called a chart list view, which basically allows you to start at the top and just quickly use your mouse button or the arrow keys to flick through a bunch of charts. And when I'm going through a series of charts, first thing in the morning as part of my morning coffee routine as a way of breaking down my portfolio and looking for areas of weakness or strength, the chart list view is what I use all the time. We call that view all in different parts of our platform, but it's a great way to just scan through a list of charts and try to make sense of what you're seeing. That is the 4th of the top 5 charts of 2023, really looking at leadership, and we focused on the performance of different cap tiers year to date. Again, when you look back at the end of the year, I think it's really important to think about leadership trends. We have quite a broad advance here, as we talked about in our 3rd video, looking at breadth conditions, but looking at performance of large versus small, growth versus value, I think tells you a lot about what you need to know about those themes in 2023. Going into next year, I think it's a lot about those magnificent 7 stocks. If the ones that broke out continue to move higher, the ones that are not quite breaking out, like NVIDIA, does it get above $500 a share in the first quarter and continue to press this bullish phase to the upside? For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great holiday, and we'll see you in 2024.